All right, let's jump straight into today's explainer. We're looking at a genuinely fascinating financial setup over at Universal Technical Institute, ticker UTI. If you track the education sector, you know UTI has been making some serious noise lately. But their Q2 fiscal 2026 results present this wild contradiction. We're talking surging enrollments, record breaking stock highs, but a bottom line that looks like it just fell off a cliff. So, are we looking at a case of short term pain for long term gain? Let's break it down. Here is our roadmap for the analysis. 1. UTI's current snapshot. 2. The revenue versus profit paradox. 3. Decoding the North Star strategy. 4. Student outcomes and growth. And 5. Stock and shareholder dynamics. Section 1. UTI's current snapshot. Educating the essential workforce. Okay, so founded back in 1965, UTI is way more than just a handful of classrooms. They are a massive workforce solutions provider. Right now, they're operating 16 UTI campuses across 9 states, plus 18 Concord Career College campuses spanning 8 states. And they're not hitting the brakes either, with new locations already announced in Atlanta and Salt Lake City. They are literally building the physical infrastructure to train America's essential workers. And what's really smart about their setup is the programmatic diversification. Through their 2 main divisions, they are training students in highly in-demand fields that are pretty well insulated from, say, tech industry layoffs. You've got transportation, energy, and skilled trades like welding on the UTI side, and that's beautifully balanced by allied health, dental, nursing, and medical diagnostics on the Concord side. Section 2. The revenue versus profit paradox. Booming business, squeezed bottom line. Now here is where we hit that stark contrast. On the top line, business is absolutely booming. Revenue jumped 6.7% year over year, hitting $221.4 million. But then you look at the bottom line. Net income plummeted from a very healthy $11.4 million to just $400,000. Adjusted EBITDA took a 51% hit too. If you just glanced at net income, you'd think, uh-oh, trouble, but top-line growth is solid. So what exactly is eating the margins? Well, the primary culprit is exactly $11 million. That's the massive strategic growth expense incurred this quarter alone. And if we zoom out to the year to date, that number sits at roughly $19 million. To their credit, management is being totally transparent about this. Earnings are taking a temporary hit because they are aggressively pouring capital right back into growth. Section 3. Decoding the North Star strategy. Optimize, add, new. This heavy spending isn't an accident. UTI is currently in phase 2 of what they call their North Star strategy, which relies on 3 core tenets. Optimize current programs to boost capacity, add successful programs into existing campuses that don't currently have them, and launch entirely new in-demand programs. They're also getting smart with geography, opening skilled trades-only locations that need less space and way lower startup costs than those massive auto and diesel facilities. And honestly, as analysts, this perfectly illustrates the financial logic behind that short-term pain. When you check out the projected internal rates of return, the expected annual growth rate of these investments, the strategy just makes total sense. Sure, they're spending heavily now, but look at the yields. Adding a new HVAC program requires about $500,000 in capex, but it boasts an IRR of over 70%, with return on invested capital hitting 95% by year 10. Even entirely new campuses are projecting 25 to 35% IRRs. They're giving up a few million in net income today to capture massive, durable cash flows tomorrow. We're actually seeing this physical expansion play out in real time. Early indicators are highly validating. The new San Antonio campus opened in March, and initial student starts were roughly 60% above projections. Incredible, right? The new Atlanta campus is tracking ahead of its July opening too. Plus, they've announced a massive 113,000 square foot Salt Lake City campus for 2027, built to serve over 3,000 students. The blueprint is clearly scalable. Section 4. Student Outcomes and Growth, the leading indicators. But beyond the real estate, are students actually showing up? The enrollment metrics say yes, absolutely. Average full-time active students grew 7.2% to over 26,000. Better yet, total new student starts surged by nearly 14%, hitting 7,569 for the quarter. Both the UTI and Concord divisions saw double-digit growth in new starts, which really proves the demand for skilled trades and healthcare education is robust across the board. Crucially, even as they scale rapidly, the educational outcomes are holding strong. Across the enterprise, they boast a roughly 74% graduation rate and a 79% employment rate. And get this, an impressive 0% cohort default rate on student loans. Now, full disclosure, the sources note that's partly aided by the recent federal pause on loan payments, but combined with an 81% 90-10 ratio, meaning they're safely below the cap for government aid revenue, their regulatory metrics are rock solid. They are successfully getting students into the workforce. Section 5. Stock and shareholder dynamics. A meteoric rise and insider shifts. Okay, to put it mildly, UTI's stock has been on an absolute tear. Back in 2023, the average price was just under $8. Fast forward to mid-2026, it touched an all-time high of $44.90 in early June. That is a staggering multi-year run. The market is completely shrugging off that Q2 net income dip because investors are clearly pricing in the long-term cash flows of the North Star strategy. This massive market cap growth, now topping $2 billion, just earned the company official inclusion into the prestigious S&P Small Cap 600 Index. That's a huge milestone. It often forces institutional buying, essentially cementing their status on Wall Street as a real heavyweight in the education sector. However, we have to look impartially at the insider shifts. Longtime major shareholder Coliseum Capital recently took advantage of this massive run. In early June, they sold roughly 3 million shares in block trades at $41.40 a pop, officially dropping below that key 5% ownership threshold. It's a classic case of taking profits after a monumental gain, and they have agreed to a lockup on the remaining 1.7% stake until after the upcoming earnings release. So where does this leave us? UTI is executing a massive, highly calculated gamble. They're sticking to their full-year guidance and targeting over $1.2 billion in revenue by 2029. The ultimate question is this: will these aggressive multi-million-dollar campus expansions unlock that massive revenue target, or will ongoing capital costs and growing pains persistently drag on the bottom line? It is a fascinating structural shift, and we will definitely be watching to see how the next phase unfolds. Thanks for joining me for this explainer, and keep your eyes on the data.